Hello there, and welcome to iSectors' first quarter 2025 video review of the three iSectors alternative allocation models. My name is John Koch, iSectors' Chief Investment Officer, and I'm joined by the CEO of iSectors, Vern Sumnicht. So today we'll go through a quick rundown of our alternative allocation models, how they've performed so far in 2025, along with a look at some changes we made in these models during the first quarter. If you aren't familiar with these models, I'll give you a quick introduction to them now. The iSectors Inflation Protection Allocation is a model designed to help protect against the erosion of purchasing power brought about by inflation. It invests primarily in real assets with a satellite allocation to short-term tips. The iSectors Liquid Alternatives Allocation is a more broadly diversified alternative model. It has a real assets bucket with many of the same investments that inflation protection has, without the tips, of course. But it also has a smaller alternative private equity bucket and a larger hedge fund strategy bucket, which is made up of ETFs that try to mimic strategies employed by hedge funds: merger arbitrage, long short equity, managed futures, market neutral, things like that. The iSectors Precious Metals Allocation is a more high octane version of inflation protection. It's also designed to help preserve purchasing power over the long term, but as the name suggests, it's more narrowly focused in only gold, silver, platinum, and palladium ETFs and closed-end funds. And as you can see on the chart on the right, because of that narrow focus of precious metals, that model has performed the best of all three of our alternative models so far this year, up over 17% net of iSectors management fees in the first quarter of 2025. Inflation protection and liquid alternatives also boast positive returns, that looks pretty good in the face of negative returns for the broad stock market in the first quarter of 2025. The last 6 months has been basically the same story. The S&P 500 is negative, the light blue line at negative 2% here, and these three models are positive, with precious metals in red. Once again, the best performer of the three, with inflation protection in second, in green, and liquid alternatives in dark blue in third. Liquid alts, this order in a environment like this is to be expected. Liquid alts is more diversified, and it's shown less volatility over time than precious metals and inflation protection. So this sort of return profile is to be expected in the first quarter and over the last 6 months here. I want to get to the changes we've made in these models this last quarter. Hopefully we'll be able then to improve even further upon this performance we've had in the last 6 months going forward. Okay, so as I mentioned earlier, the inflation protection allocation is focused on real assets with an allocation to short-term tips to help reduce volatility. We use short-term tips compared to long-term tips because there's essentially no interest rate risk baked into the short-term tips, and you really get a more pure exposure to the inflation adjustment in those bonds. Longer-term tips, just the broad tips market or the broad tips ETFs that you can use, they tend to move more closely to the broad bond market because the duration is somewhere 5, 6, 7, similar to the Bloomberg Aggregate Bond Index. And that's exactly what we saw. Like in 2022, short-term tips held steady, and longer-term tips, as bonds sold off and interest rates spiked, long-term tips sold off as well in 2022. The interest rate risk outweighed the inflation adjustment in those bonds during that period. And so this model performed pretty well in 2022 to go along with the positive performance we've seen so far this year. Within the real asset portion of the inflation protection model, we're currently invested in broad commodities, gold, silver, natural resources, which includes a broad natural resource equity ETF, and a more narrowly focused North American pipeline ETF as well that we lump into the natural resources category. And one change we did make in this model, last quarter, we sold a portion of that broad natural resource ETF, and we bought a spot Bitcoin ETF. We already had Bitcoin as a part of our liquid alternatives model last year, but this quarter we also wanted to add it to our inflation protection model as well in the real assets bucket. And actually, inflation protection isn't the only model we added Bitcoin to last quarter. We also added it to all of our other models with equity exposure as well, because just firm-wide, we have a pretty strong conviction in Bitcoin. And we're not going to get into that today, but you can read a detailed write-up of the reasoning behind our conviction in the article that's linked down below in the description of this video. Okay, on to liquid alternatives. So the changes we made to our liquid alternatives model last quarter was different than what we changed in the inflation protection model. As I mentioned before, we already had a spot Bitcoin ETF allocation in liquid alternatives. We had that for about a year now, and that's paid off pretty well within this model. But we didn't change that. We kept that 5% allocation to spot Bitcoin within liquid alternatives. But what we did change are the vehicles that we use within the hedge strategy portion of the model. You can see here the three different buckets that we group the holdings in this model that I mentioned before: alternative private equity, hedge strategies, and real assets. You'll notice in the hedge strategy bucket, they are now all ETFs. Previously, we owned some mutual funds within that hedge strategy bucket of the model, but we made the decision last quarter to fully commit to the ETF investment strategist theme that our firm has. And this was really one of the last models with any mutual fund exposure. So we decided to convert and find as close as possible strategies for the mutual funds we owned in ETF format last quarter. So for example, we found a market neutral ETF when we had been using a market neutral mutual fund. We found a long short equity ETF when we had been using a long short equity mutual fund. And in doing this, the underlying vehicle costs of the model were reduced, and we're also able to reduce the investment minimum on our TAMP platforms like InvestNet, for example. InvestNet, the investment minimum went from 50,000 down to 25,000 for this model. And we know some of our advisors, they like to use these alternative models in smaller accounts, in smaller portions. They don't like to allocate full-size accounts to this a lot of the time. So hopefully this will make our liquid alternatives model just more usable for the advisors who like to use the iSectors models.
It also reduced our fees, right, John?
Yeah, yep, the fees as
well.
Yeah,
the underlying, yeah, because the mutual fund fees were a lot higher. When we actually started this model 10 plus years ago, we didn't have any choice but to have quite a few mutual funds in the portfolio to find the strategies, especially the hedge fund strategies. And over time, as the ETF world has gotten larger and larger, we've been able to find ETFs to replace those mutual funds, and again at quite a bit lower cost and much more efficient. And in addition, none of our hedge fund ETFs have K1s, right? So this also helps for tax preparation purposes. So the models really hasn't changed the strategy at all. It's just been able to find better vehicles.
Yep. Yeah. Essentially, if you're looking for like a hedge fund replacement type of strategy, liquid alternatives, it's right in the name. You don't have to be an accredited investor. The minimums are much lower. Like I said, the fees are lower. So all in all, it really is an appealing model that we really want to shed some more light on, especially in this current environment that we're going through right now.
And yeah, no 2 and 20% of profits. You don't have to be an accredited investor. You can use it in because there's no leverage. You can use it in the like foundations, IRAs, etc. And there's immediate in and out, right? So they're very liquid. There's no waiting a year to get out of this model versus a traditional private partnership that might use these hedge fund strategies. And our model has outperformed the HFR hedge fund index forever, consistently. Over a 1 year, 3 year, 5 year, 10-year period, it's been consistently outperformed the HFR hedge fund index. So it's a good alternative for people that want to really diversify their client portfolios with some different and truly different strategies.
Yep, exactly.
Go ahead, John. I'm sorry to interrupt.
Nope, that's all good. So, yep. So we go from our broad alternatives model to our most narrowly focused alternatives model. So the precious metals allocation is one of the few models in our lineup that we did not add Bitcoin to last quarter. We want to keep this model as pure as possible for those looking to invest in precious metals. We want it to be a true pure play and leave it on its own, essentially, just with Right now, gold, silver, and platinum only. You'll notice I mentioned palladium earlier. We aren't currently invested in any palladium. That's one of the changes that we made last quarter. We fully sold out of palladium for the first time in the model's existence, I believe. There'd always been platinum and palladium together, sort of complementing each other. Those two really can be seen as sister metals. They're substitutes for each other, in catalytic converters. Currently there's price parity between the two. The prices are very close as well. The big difference, though, is that palladium's price over the last 5, 10, 15 years has been much more volatile than that of platinum. It had a very good run up in the mid 2010s. Palladium did, where it contributed positively to this model. But in recent periods, the volatility has really outweighed any positive performance that's come from it. So besides the volatility, though, too, both platinum and palladium right now, they're currently in a supply deficit, which is why we had them included in the model, and that it was appealing, both of them being in a supply deficit, that the price could rise, like it did with palladium, as I mentioned, in the mid 2010s. But right now, palladium is projected for that deficit to reach a surplus a couple of years before platinum does. We did some pretty heavy research on this last quarter, and based on the current supply right now and the amount being mined between platinum and palladium, platinum really is the better metal of the two to be invested in. And so when we sold palladium, we added a little bit of platinum. We split the proceeds between platinum and gold. We can see here about 54% gold. That was only about just under 50% last quarter. Gold has been by far the best performing precious metal in the last 5-10 years, the least volatile, the most steady. It is the most, I guess, the most precious of these precious metals, right? It is seen as a true safe haven, and that's what we have seen so far this year, that the inflows into gold have been high, the performance has been high. The price now is over its all-time highs, over $33,000 an ounce, $3,300 it reached. And we wanted to add to gold before any huge price jumps happened. And we were actually we added this at the end of February before it reached $3,000 an ounce. So we were able to capitalize a little bit on this recent run up above 3,000 to all-time highs in adding to gold after we sold palladium. So
well, another interesting point about our gold allocation is we're using the Canadian closed-end funds, and that's on purpose because we're using a U.S. ETF, for example, you're going to be taxed as a collectible 28% on your gains, whereas by owning the gold in the Canadian funds, it's not considered a collectible. And so your capital gains rate will be whatever the client's underlying capital gains rate is. It won't be 28% as a collectible. So that's just another point.
Mm-hmm. We also own the silver Canadian closed-end fund as well. So both our gold and silver positions are in those closed-end funds. And I mentioned earlier, we sold all of our open-ended mutual funds out of liquid alternatives. We do still own those closed-end funds within precious metals because of that tax advantage, the Canadian closed-end.
And also, I mean, the other reason we want to own those is because the gold is allocated, right? So the Canadian gold and gold funds, 100% of the gold and silver is allocated, meaning it's, it's there. It's in bullion banks. It's got, serial numbers. They're audited, whereas like a gold ETF, there is paper ETF in there, unallocated gold, so to speak. We feel much more comfortable should we decide, hey, we want our gold, we want our silver, we will get our gold and we will get our silver. So that's is one of the things that's kind of questionable about the US ETF gold ETFs. Although they're large, they do have a pretty good portion that is not allocated, so to speak.
Mm-hmm.
So
yeah, exactly. Good points, Vern. Thank you. So that's all we have today on these models. You can reach out to myself or Scott Jones, our Director of Business Development, if you have any questions. And besides that, thanks everybody for watching. Thanks, Vern, for helping out.